Have you ever noticed that mortgage rates go up or down even when the Fed doesn't do anything? Or maybe you hear on the news that the Fed paused or even hinted at cutting rates, but mortgage rates still move the opposite direction. If you've ever felt confused by that, you're not alone. Today I'm going to break down in plain English what actually makes interest rates go up or down, why mortgage rates don't move the way most people expect, and why the bond market is the closest indicator we have for where mortgage rates are headed. This isn't an economics class. This is for regular people trying to make smart decisions about buying, selling, or refinancing a home. One of the biggest misconceptions in real estate is that the Federal Reserve controls mortgage rates. Well, they don't. The Fed controls short-term interest rates, things like overnight lending, credit cards, and savings accounts. Mortgage rates are long-term loans, and long-term rates are driven mostly by the bond market. That difference is everything, and here's why. When you get a mortgage, that loan doesn't just sit in the bank forever. It's usually bundled together with other loans and sold to investors. Those investors are deciding where to put their money. They can buy stocks, they can buy bonds, or they can buy mortgage-backed securities. So mortgage rates are constantly competing with bonds for investor money. Here's the most important relationship to understand. When bond prices go up, bond yields go down, and mortgage rates usually follow down. When bond prices go down, yields go up, and mortgage rates usually rise. Bond prices and yields move in opposite directions. Once you understand that, mortgage rate movement starts to make a lot more sense. Think of it this way. If investors are willing to accept a lower return on bonds, lenders can afford to offer lower mortgage rates. But if investors demand higher returns elsewhere, mortgage rates have to rise to stay competitive. That's it. It's not random. It's not emotional. It's supply, demand, and expectation. So, what actually makes bonds move? There are three main drivers: inflation, economic strength and jobs, and fear or uncertainty. Inflation is the biggest one. Inflation reduces the future buying power of money. So if investors believe inflation will stay high, they demand higher interest rates to protect themselves. If inflation looks like it's cooling, investors are more willing to accept lower yields, and that helps bring mortgage rates down. This is why mortgage rates often move before inflation looks perfect on paper. The bond market doesn't wait for confirmation. It moves on expectation. The second driver is the strength of the economy. Strong job growth, rising wages, and heavy consumer spending usually push rates higher. A slowing economy, weaker hiring, or signs of a recession usually pull rates lower. That's why a single jobs report can move mortgage rates in one day. Markets aren't reacting to how things feel right now. They're pricing where they think things will be in 6 to 12 months. The third driver is fear and uncertainty. When there's uncertainty, wars, elections, banking stress, global instability, money tends to move into safer investments like US bonds. More demand for bonds pushes yield down, and when yields come down, mortgage rates often follow. This is why rates sometimes fall during bad news. Now, where does the Fed fit into all of this? The Fed still matters, especially their messaging and guidance, but markets don't wait for them to act. They react to what they believe the Federal Reserve will do next. That's why you'll sometimes see mortgage rates drop before the Fed's cut, and why rates often rise even when the Fed pauses. The bond market is always looking ahead. This is also why watching headlines alone can be misleading. By the time the headline hits your phone, the market has often already moved. Mortgage rates don't react to the news. They react to expectations about the future. So, what's the real takeaway here? If you're watching interest rates, don't just focus on one announcement or one headline. Pay attention to inflation trends. Pay attention to economic momentum. Pay attention to investor sentiment. And understand that mortgage rates move ahead of the news, not after it. This is also why waiting for the perfect rate can backfire. Rates move fast, expectations change quickly, and strategy matters more than guessing. If this helped you understand interest rates a little bit better, feel free to share it with someone who could use this. Make sure you like, subscribe, and drop a question in the comments. Once again, thank you for watching Francisco's Key Insights. See you next time.